Hello, everyone. Welcome to the Global Markets in the Face of COVID webinar. First of all, uh, we're thrilled to have such an amazing lineup. But before I go through the introduction with the panelists, I would like to thank all the institutions that help us do this possible, especially Tradier, the Mexican Stock Exchange, of course, educational institutions like Georgetown University, Universidad Panamericana, University of Chicago, Gade Business School, and of course, the collaboration of Jaime Lázaro from BBVA Asset Management and other partners like Toggle. Sorry. I would like to also announce and thank the Mexican Stock Exchange for setting up a completely free educational program for all the participants on the Picture Weekly Challenge. The course will be Introduction to Financial Instruments. This will be a program in Spanish, and I would really like to thank Gerardo Aparicio and Jose Oriol Bosch from the Mexican Stock Exchange. Thanks for your efforts and your contribution to the financial education. I already received great feedback from our crowd. They're willing to start with that. We'll announce that details very soon. Thanks, Gerardo. Another quite non-related but a little bit related announcement. We're partnering with a nonprofit organization which is called Vida Sin COVID. It's a novel initiative to help micro, small, and medium business to reactivate some of their activities. I'll put the link in the chat for anyone that's interested. And I think it's what we can do right now. I will start the introduction in alphabetical order. So Alex Deal, thank you very much for joining. Alex is a professor in the financial mathematics program and lecturer in law at the UCLA School of Law, author of the book Bank Regulation, Risk Management, and Compliance. Thank you very much, Alex, for joining us. Gerardo Aparicio, he's the director of the Mexican School of the director of the School of the Mexican Stock Exchange. Gerardo, thanks so much, and we really appreciate your contributions in all this effort. Jaime Lázaro, Igor Rivera, he holds a PhD in finance. He's the director and associate professor of the Masters in Finance at Agade Business School. Jaime Lázaro, CFA and general manager of BBVA Asset Management Mexico. Thomas, distinguished professor at Georgetown University, Robert E. McDonald School of Business, and Salvador Rivas Aceves, PhD in Economic Sciences, academic dean as well as research dean of the Government and Economic School at the Universidad Panamericana. Thank you very much to everyone. It's quite a lineup, and we're thrilled to have you all here. Welcome. Everyone.
Thank you. Thank you very much.
Thank you so much.
The dynamic will be the following. I will ask each one of you a question on your specific field, and in alphabetical order, and then we can have a chat between the panelists and take some questions from the people that joined the webinar. Is that okay with all of you?
Perfect.
Yes.
Good.
So I'll start with Alex. Alex, we know you have a lot of background in ratings and risk management, especially on credit and ratings. What do you think, or what can you tell us about the impacts in the deficit and the huge amount of debt that the U.S. taking by the fiscal and monetary stimulus, like the quantitative easing? Can you give us a little bit on what do you
Sure.
think are?
Sure. You know, my background is structured finance ratings, but I do know to some extent how the sovereign ratings go. I've actually just looked at the ratings of the three big rating agencies, Moody's, S&P, and Fitch. And as some of you probably know, S&P downgraded the U.S. government debt, general debt, to AA. And AA plus, I guess it is, and that was in 2011. But more to my company, Moody's, my former company, they are still AAA stable, and that is the current rating. It's not a negative watch, it's stable. And this is after everything that has happened in the last couple months. So they looked at the debt that the government is taking on, some up to $3 trillion in the first installments of the legislative packages. And then now, of course, we're talking about 3 trillion more. I don't know where that's going. There is more hesitation, I think, in Congress to press a button for that. But there's no question it's going to have a huge impact. The GDP it's projected, Moody's is projecting it to go down in 2020, something like 5 to 6% negative, and then something like an 18% deficit, which is really unheard of. It's slowly going to come back up in the next couple of years, but it's not going to be, you know, a sudden upturn with extinguishment of the debt. It's going to be there for quite a long time. And this was going into the crisis in not too great shape with already quite a big deficit. And then I'll finish here. I'll just say, when I was at Moody's, I had a ratings practice where I was looking at bond covenant ratings, and the covenant protections in bonds, corporate bonds, are all-time low in terms of protection, as well as in leveraged loans. So on that score, it doesn't look good. This is going into the crisis. So the bottom line is, for the time being, it looks like the U.S. government is still doing okay with its ratings. Fitch also has a AAA, but it's on negative. So I hope that answers your question.
Yeah, and what, like, if the U.S. government is not anymore AAA or whatever, what does that mean for, you know, like risk-free? There's no more risk-free?
Yeah, the risk-free is actually a current issue right now because of what the Federal Reserve has been doing with flooding the market with huge amounts of trillions of dollars of liquidity. And there is a really big question: are they distorting the treasury market to the extent that you really don't know what the risk-free rate is? And as everybody on this webinar knows, the U.S. Treasury market sets the kind of the benchmark for all the other equity as well as debt instruments in the world. So this is a pretty serious matter. Yeah, currently I think it's really an issue. As you probably know, in March there was quite a lot of turmoil in the treasury market with all of a sudden yield shooting upwards. And so it's not functioning like it should be.
Yeah, it's tough to think about that right now. There's no single asset, based on the ratings and so that it's risk free, right? That's something that I've never thought I would see. But
Right, can you
thanks so much
trust the
for
treasury market? We saw something at the end of last year where it also had a problem in the treasury repo market. And so that's where it occurred now. That just is a commentary on the huge amount of debt in the financial system. With hedge funds, they were doing asset sales. So that was, the asset sales they were doing were treasury bonds. So nobody was there. The primary dealers weren't really geared up to take that amount of supply. So that's why the Federal Reserve had to kind of step in as a dealer of last resort. So it's not a pretty picture. It seems like the worst of it is over. So, but with all the liquidity in the market, who knows what the real rate is for risk-free rate is.
Thank you very much, Alex, for your input. I'm sure we'll have time to come back to that. Now I will go with Gerardo Aparicio.
Yes.
Gerardo, I think, are you unmuted? Yeah. So with your experience and working, very close in the Mexican stock exchange, what would you say, or what do you think that are probably some assets that are worth to consider investing in the current environment and with the current crisis?
Okay, thank you very much, Juan, and it was a pleasure to be with each one of you who make up the forum today. Is real a very good idea, the PIP trade and the stock market school. The question is very interesting. Since we have always known that the financial market is a place that offers us many and diverse investment opportunities. In this moment that we are in the crisis, in the financial crisis around the world, is the crisis most important in the history. However, the usual recommendation is that the amount of assets available on the stock market for all the people will be the best if there is clarity or is not the best idea if you don't have the clarity in the objectives and strategy how investor that you expect in the assets on the market. Now, the investors looking for enterprise or companies that they complete some points very important. For example, the investors need a company that the company knows the market, knows very well, and I think they feel secure if the company, they have scalability in their process, if they have a marginal cost, for example. I want a company with a very big technology and a business model very good right now. And in the company, in the stock market, in the capital markets, maybe the one question is, you need a company that they have a team of people behind to the execution, the process. And I think if you have your objectives very clear with a strategy, the stock markets offer to you a very good instrument, even if you are in the financial crisis.
Sorry, what you're saying, it's you need to know the goals before investing and probably know what the company is doing and maybe position yourself on these companies that have a bright future in you know, like it could be defensive in this environment.
Yes, of course. At first, you need the goals and why you invest on the market. Maybe this is the question. Because if you don't have the goals, if you don't have what is your strategy, even you have a lot of instruments on the market, maybe your strategy for investment is not very good. But if you are, or if you have the goals, you looking for a very good instrument in the financial market.
Thank you, Gerardo. Thanks a lot for your input. Let's see who's else. Igor, you know, I think we would love to hear someone with your background. What are you looking right now in the Mexican markets? Give me 1 second.
I'm unmuted now.
Okay.
Very good. Thank you. Well, I like to start first by thanking P-Trade, the Mexican Stock Exchange, and Trier for having me into this panel, for the opportunity of reaching out with some old good friends such as Thomas Cook, Jaime Lázaro, and Gerardo Aparicio, and some new good friends like Alex and Salvador. What I can see for the Mexican, particularly the stock market, is some sort of mixed signals. On the one hand, we can see that we have a certain correlation to American markets. We had this drop in the last few weeks. I think that Standard & Poor's went down by something like 33% or so. The Mexican Stock Exchange went down for something like 28%. Huge drops, but very consistent with the outlook for the economic performance around the world. Now, the interesting thing is that whereas in the American market, we had witnessed a recovery of something like 20 percent points in the last weeks. In Mexico, we are just getting a recovery of something around 10 percent points. So that's something that is happening, that is making a Mexican recovery, or the recovery of the Mexican economy, is lower than what we can see in some other economies. One other feature that seems to be interesting to analyze is that whereas in the American market, we are now we are actually seeing some sort of high price to earning ratios. In the Mexican Stock Exchange, we are looking at very low or somehow low price to earnings ratios, meaning that apparently those are very hot peaks and very good opportunities. However, I think that there might be as it always happens during crisis, that the statistics might be somehow misleading at this moment. For instance, correlations are very bad tools during crisis times. And in this case, this situation of price to earnings are not just related to the movement of prices, but they are also related to the drop in earnings around the globe. But at some point, this shift in earnings might be affecting differently in different economies due to their operating leverage, right? So I think that earnings in the US have been affected harder than in the Mexican firms, and probably this might be one reason of having very high price to earning ratios in the US and not that high in Mexico. Now, considering what might be coming soon, well, on the one hand, we are looking at all the stimuli in some markets, such as the American. I think that will boost importantly stock markets, generally speaking. I think that those might be opportunities on that specific asset class for a little while. And probably when we are get done with this effect of the stimuli, then there would be a nice time to switch strategies, probably to something more on the debt side. Finally, I think that there's another feature to be aware of, and is that regardless of the direction of the markets, I think we are going to be facing lots of volatility. And this is mainly related to the scaling up of the conflict among the US government and the Chinese government in so many areas and so many fronts. On the one hand, there's a lot of, talking about where the virus was originally outbreaking, or all disputes of the trade war that were not really settled on their time. Some other features about the transparency of the accounting in Chinese firms. All these situations are gonna be pushing somehow at markets with lots of information, and you know that in markets, more information means more volatility.
Yeah. So would you attribute that on correlation with the U.S. markets based on the different measures that the different governments took? Like, for instance, we see on one hand the U.S. taking huge amount of money and putting it into the market and into the economy, and in Mexico we don't have that. We didn't have that approach. Let's put it that way.
Yes, I think that that might be one reason. On the one hand, we see that these policies put in place in the US are quite aggressive, and actually they are quite related to the question that you placed for Alex previously. On the other hand, we have this other style of policies that we are driving domestically. I think that there's a large load on some of these policies trying to look for a lot of fiscal discipline here in Mexico, which at some point is good, considering that in some other times we might have some sort of actions that might not be properly oriented. For instance, letting the debt levels grow when it wasn't needed. I think that that might not be a good idea in the past. But nowadays, well, we have, in economics, we have these two sort of leverage. One is fiscal policy, and the other one is monetary policy. And at this point, I think that we are in some sort of dead end, considering that on the one hand, there's little room for, let's say, rate cut, right? Because you have rating agencies like downgrading the rating for Mexico. So if you cut rates at this point, you're going to have a massive outflow of international investors, right? On the other hand, this fiscal policy, it is related to that style. So I don't really see a lot of opportunity of having a radical switch into a more aggressive policy. However, I see some opportunities probably on the side of some sort of fiscal concessions to local firms in the form of fiscal credits, right? I think that that might work on this side as a good way of signaling for intentions of making this wheel to keep walking or keep steering.
Thank you very much for your bi-level input. And now, Jaime, it would be great to listen your opinion as the head of asset management of the largest bank in Mexico. How do you think this crisis, this virus and the COVID will affect the asset management industry?
Well, I think all these kind of crises tend to help on the long run the industry, because we learn from them, and we try to build solutions that fit investors in a more efficient way. Usually the business suppose that all investors knew how to do a portfolio optimization, and they knew how to calculate the proper value of all the assets, but this is not true. So with time, the industry has evolved to provide better build-up solutions for clients. And with this, I'm referring to try to keep all the sophisticated language into the building process of the products or the investment process and the tools we use to create the portfolios. But in terms of how to market all these, we have to provide a language that is understandable for everyone. So we have to switch the traditional concepts that we financials use to provide a language that is understandable for everyone. So what I'm seeing is that the industry is moving into, yes, building more sophisticated things, but in order to fulfill a language that is understandable for everyone. For example, we here in BBVA Mexico, what we have done is build all our strategy through three main strategies that are also understandable. For example, if I talk to you about value at risk or Sharpe ratios or whatever, it's very difficult to explain those kind of things to clients. But if I talk to clients about capital preservation, income generation, growth, and we combine these three strategies in order to fulfill the investment profile of each one of them, is easier, even though the products are more sophisticated, because we have to invest in many things, local and globally. And we have to incorporate diversifiers into the portfolios, like absolute return funds or something that can help us in times, as recently was mentioned about the correlation breakdown that we have seen, so we can build more stable return paths for clients. And with this, it's not just about that, it's also trying to incorporate the risk fears that investors face into the investment process. For example, trying to manage the portfolios with tools that can help us protect the capital or have maximum drawdowns in terms of the volatility that investors will face. So when we experience radical downturns in markets, as we have seen, it's perfect for us to prove that these tools help, and that even though they are sophisticated, when investors see the performance of them, and you can be consistent with what you sold in terms of what the solution will provide, I think these are also great times for us in terms of reinventing us and creating new things, and learn how to approach clients with a more understandable language.
Yeah, I totally agree with what you say. We tend to think that we're really good at investing sometimes, and I think there was a hot topic. It's been a hot topic that stock picking has not been paying off, right? And right now, if you see what's going on, is that the people that are doing stock picking and are having an active, let's say, strategy, they might be getting a lot better returns than just going into the ETFs or passive investments, passive managed investments. And right now, I'm pretty sure that there are a lot of people saying they should have leave this to some professionals.
Mm-hmm. Well, my point of view is, I agree that on an aggregate level, it's difficult to find a manager that consistently beats up the benchmarks. So if you don't have the expertise to look for these managers, the easy bet is to go passive. And it's a very, very understandable strategy. We, for example, have both passive and active strategies because we want to give everyone a solution. But I do believe that good managers, especially when we see these locations in valuations, there are active managers that can easily, well, not easily, but more easy, as if the markets are well priced or there are no dislocations, are able to find these opportunities because they have rigor, they have the expertise, they have tools, and there's of course a pitch there for active investing. So I do believe that active investing exists and helps. So the idea is to create these capabilities, to find these managers and to protect the talent, because indeed there are people that can consistently do that. But as an investor, if you don't have the ability to find that asset manager, it's easier or let's say not as riskier just to go passive. But there's a market for everyone, I think. And I say this because I do have extraordinary PMs that can provide alpha, not just on equities, but also on fixed income and credit.
And also what I meant is, for instance, we have all these people that were saying that probably active management was probably dead because of these ETFs and passive management. And also, what about that? All these, I haven't reviewed how the robo-advisors are doing right now, especially in an economy like Mexico or in the US. It's
well, in the US, there's a more market for robo-advisors, but I think that the model that has preserved is the model in which you can have the advisor of these algorithms, but also you need some human touch at some point. For example, especially in times like this, where you can think that your long-term strategy is on risk because of the downturn and the massive losses that we have seen, people get nervous. And at this time, they need to talk to someone in order to see if the long-term financial strategy is on track. So those models are these cyber combined models in which we have the powerful quantitative tool, but also you have, for these sort of times, someone to talk to. In Mexico, there is not a huge growth in terms of robo-advisor solutions, even though some of us are building some capabilities there. But I think with time and in order to get more traction with new generations, we have to have those kinds of solutions. But I also believe that the pure robo-advisor is not a long-term business solution, because when markets overreact, the behavioral biases of each and every one of us arise, and it's important also to try to tackle those down with help from people. So a mixed model, I think it's gonna preserve, and with time, Mexico will also have some kind of solutions. And we are, by the way, building one.
I'll send you an example. We saw that yesterday with Toggle, which is provided with AI, and it's a fun example. I'll share it with you. It was just about what you were talking about. But thanks so much for your contribution, Jaime. I will go to our next panelist, Thomas. Oh, no.
Well,
it's before.
Yeah, it's an honor for me to participate in today's program. I'm always curious, looking at the number of attendees. Is it going up or is it going down as we're speaking? It seems to be holding its own. So hopefully I can keep that. You know, I think if there's one theme today that I want to share with everybody, it's 3 words: education, research, and communication. and my colleague just talked on the latter one. It is so incredibly important that we communicate to our friends, to our colleagues, to create a sense, if you will, of calmness. And I fear that people have, over the last few weeks, had this rush to cash. And I think now they're kind of sitting back saying, geez, did I do that too early? Was my timing not appropriate? I am in Washington, D.C. today. We are still in a so-called official lockdown, which was extended yesterday till June the 10th. The number of cases in Washington, D.C. are increasing, but the evidence is abundantly clear, increasing significantly in some of our most economically depressed parts of the city. And that's the tragedy. The evidence is very clear that for people earning $40,000 or less, they are almost at 50% of unemployment in some parts of our city. So it's not a good situation. President Trump refers to this city as the swamp. If it was a swamp when he came to office, it's swampier today. Last night, if you can imagine, the FBI got a court order to seize the telephone of a United States senator. Not any senator, the senator who's the head of the Senate Intelligence Committee. And they seized his phone to investigate stock transactions during the early days of the virus being reported, while he was privy to reports galore from all over the world. He has fortunately today stepped down as chairman of that committee. And he's not going to be the first elected official to benefit by the so-called insider knowledge, and he certainly won't be the last. Now, nothing that I want to say today should be viewed as any recommendations on investments. As my colleague pointed out, I can tell you in Washington, the word debt and deficits are two dirty words, and they're not mentioned. What is mentioned is stimulus, free money, enhanced unemployment benefits, and sector bailouts. And you know we had a sector bailout for the airline industry, and take a look at the numbers. It's been downhill ever since. They no sooner had their hand out and got substantial sums of money to keep people on the payroll, and they turned around and said, we want more come September. The airline sector is a highly contagious sector today. Delta Airlines announced today they are getting rid of all 777 airplanes. The chief at Boeing made a statement this week that he later regretted saying, that he could see a major airline going under as a result of the pandemic. That's not a good thing, whether that happens or not. I want to say that we can all sit on the sidelines and stay in cash and not make investments, or we can do our homework and look for opportunities in challenging economic times. And I want to suggest that in good times and bad times, there's obviously winners and there's losers. My investment strategy that has worked well for me over the years, and I guess it's a benefit to being around young people, is invest in what you love and what those around you love. And so when I see what the students are needing and using and liking, that makes me stop and take a look at that investment. What is the demand? Where do I see the value? I want to recommend that we sit back and consider that this pandemic will have impact in America for 12, 18, 24 months. We are now opening states and cities for business one by one by one. Not every city has come back online, but we are gradually. There's a school of thought that we may be starting back too soon. You know, the American people can be very intelligent. We can be the most arrogant people in the world. I'll give an example. Yesterday afternoon, parties went to court in the state of Wisconsin, and they got a court order from the Supreme Court of Wisconsin that it was inappropriate for the governor to shut businesses down. And so last night we saw videos of young people galore in bars and clubs, not wearing any mask, drinking to their heart's content. And you just have to wonder, is there another wave coming? And are we going to wind up stepping back? when I look at what American consumers are in desperate need of today and companies that are performing very well, the one that shines out and want, you know, we said this a month ago, Amazon, Amazon, Amazon. We are becoming so dependent on what that company is capable of. We are, as an institution, educational institution, very dependent on Zoom, and businesses are. And I think we'll see when the dust settles, there'll be much less business travel. There'll be much less face-to-face meetings. And companies are going to see that Zoom is the way to go. We're also, by the way, you saw the Twitter announcement this week. I don't know if they meant to say this, but forever work at home. I mean, that's pretty dramatic. And I'm sure that made a lot of real estate investors rather nervous as to what that means for the rentals. And we know that's another big issue that's out there. I was listening to the CEO of McCormick Spices out of Maryland last night. Company's performing very, very well. He said, we're staying home, aren't we? We're cooking. You're buying all my spices. It's never been better. Again, it's at an opportunity. Of all the fast food establishments that have weathered the storm well, Chipotle really stands out. They have done very well as a company. Very popular, of course, and good product. And I also have paid a lot of attention to our infrastructure in terms of food deliveries. And by the way, we have rising prices on both beef, poultry, chicken. By the way, eggs, 16.1% increase in the last month. And Beyond Meat is something I've looked at rather favorably. Alternatives to the meat supply chain, they're doing very well. So I say, you know, look for things around you, things that you like, things that you think are working well. Do your appropriate research, have the appropriate conversations, look at things as a long-term investment, not, you know, next week or the week after. And I think you will, at the end of the day, be pleased that you did your homework and benefited by that type of analysis. So again, this is just a great opportunity today to share a lot of thoughts with a very distinguished panel. And I think each of us, I hope, has added something of value to our audience. And I'm looking at our numbers are holding steady. So that's a good sign. And any questions people have, we'll all be happy to answer. So thank you, Juan, for the opportunity. Thank you and the company, by the way, for your contribution to education, education, education. At the end of the day, that's what it's all about.
Thank you very much, Thomas. It's always a pleasure to listen to you, and great contribution as well, as always. Sorry, Salvador, I don't know. I'm not good at, you know, I thought the T was before the S, but I just.
It's okay.
Sorry for that. As an expert in micro and macroeconomic research, what do you think what will be the impact in emerging market economies, and more specifically Mexico, in terms of a little bit more macroeconomic?
Yeah, well, I believe that we just need to look back for a few months and start by understanding that we are now in a crisis of crisis. That is, we first went through an economic recession around the beginning of the 2019. And then suddenly we also were experiencing the trade war and of course the pandemic. So we have several different types of crises happening right now at the same time. So with that in mind, that we are just into a crisis for several crises, the macroeconomic scenario looks like very, very complicated. And as my fellow panelists already explained in a very, very detailed way, information, it's everything. And nowadays you look for example, the European markets, and they are having really particular, well-integrated economic policy for facing this crisis, this general crisis. And then you look for North America, for example, and there is issuing debt in order to face the economic recession. When you look, for example, in Latin America or South America, programs look really, really different. So it's all came about like what's the information that is relevant for taking a decision to me. So when you have a lot of uncertainty and when you have several economic indicators that are telling you that things are not going well, that there is a really high rates of unemployment, and there is also the economic growth rate decreasing in several regions around the world. And you have also seen that there is prices going down because the aggregate demand is also going down. Why? Because we are staying at home, so economic activities are getting down as well. And when you see that, for example, only industry that is making basic goods for satisfying needs, basic needs, that industry is the only one that could be performing like acceptable way. The rest of the industries, for example, manufacturers or services or telecommunications, so far so on, they are having a high impact because of this economic recession. So it is not easy to understand how the market is going on the future if we don't have the security for that economic activities are going to get back on track. And that will be only happening if the health crisis could solve. For me, if there is no vaccine for the COVID-19, it would be hard for the economy around the world to be back on track as it used to be. So nowadays, these several types of information from different parts of the world are really making not easy to take decision, as for example, Thomas and Igor and Jaime were telling us that information comes with as well as uncertainty and volatility. So I will stand by the side of Thomas in the sense of you need to do your research as well. You need to be very well informed. You need to prove the information you possess in order to make decisions. Because as we already seen for several years now, economic activities and the economic behavior around the world is always linked to the financial system. And if we are looking for economic indicators that are having a terrible performance, that it's always not a good sign.
Yeah, I think right now it's tough to be an economist, right?
It is really tough, yeah, because you have several different indicators going down, and then by a few hours later they are coming up, and it's really confusing. You don't understand. For example, yesterday Chile announced that they're going to a total quarantine. So that means that economic activities down there is going to be almost null, right? So if there is no hope for you to have an economic activity, therefore the economic performance of a company will be unknown. And how can you invest on that company? I mean, it's really difficult for you to find a great field for taking the decision. But as Jaime told us, that there is always room for something positive around to invest on.
Okay, so I want to launch one question before we go with the questions here. What is your opinion in general? And whoever can, we can take this discussion. We're seeing a divorce between economic data in the US. Well, that's my perception. That's how I see it. It's completely divorced economic and earnings information and what we're looking at the markets. That's, you know, I'm just reading every day the news, and unemployment 14% in the US, and you know it will keep adding up. And the markets are, if we look at the S&P, we're probably flat from 1 year ago. If we look at May 2019, and we look at right now where the S&P is, it's probably at the same level. And back in 2019 in May, I don't remember what was the problem over there. So if I'm going to unmute all of you, and maybe you can, you know, try to like, I would love to hear your opinion on this one.
One thing I'd like to add that's frustrating is the number of companies that are giving us earnings reports without any guidance. And this is it's a most unusual environment. I understand why there's fear or concern with issuing guidance, but that makes it very difficult for investors to truly understand the landscape. You kind of have to make some assumptions along the way. So I give an example. We know that Apple shut down all corporate stores in the United States. We know there were issues with supplies coming out of China. We now see that looks like that's getting better, and stores are starting to open. But in spite of that, Apple is reluctant to issue any forecasting moving forward. They will have a major event in June announcing, we believe, some new products. So there's more legwork involved now. And I'm not saying you should read into the lack of guidance as a purely negative thing. I think companies just don't want to be on the hook for having given out some advice or some guidance that turned out not to be real. So it's a very challenging, it's a lot easier to sit on the sideline and just say, I give up, and let me watch, see where the dust settles. But again, I think with homework and with research, there are opportunities to be found.
Yeah, because I'm looking at all these news, and you know what Alex was saying, that you know there's no any more risk-free basically, and looking at the markets 5 or 6% down, it's something that I'm probably more I don't know. They're looking probably more at the stimulus than the economic data, isn't it?
Well, you know, the other issue that's out there is, at the end of the day, how many people currently laid off will be retained? I think what we're seeing now is companies are realizing, maybe I didn't really need all these people. So the unemployment number, there were 3 million more people seeking unemployment. By the way, you quoted 14%. That's the so-called official number. We believe that is seriously underreported because X number of people are not counted at all. So we're definitely approaching 20% by the middle of the summer, and that's just not a good thing. So I think we're finding small businesses are folding completely. People are unable to pay rents, unable to pay salaries, and the economic outlook across the board is not very encouraging right now. So again, you have to look for sunshine in the middle of a very dark storm, is what I would say.
What is your opinion, Alex, on that? I want to talk about specifically the U.S., where we see these, you know, there's no correlation between the economic and the market. Is that the stimulus, would you say?
That's right. It's a real disconnect. And a lot of the market commentators are talking about a V-shaped recovery, but the economists are, I think, more cautious about what it's going to look like. Is it going to be a Nike swoosh, or is it going to be a W with another outbreak at the end of this year? So I don't think the market has built in the full import of all this news that is coming into the market. They tend to react to stimulus packages coming from Congress. If they do not come to an agreement on this next package, I would think that the stock market would take quite a big hit at that point. They're really looking at supports for the market. What else can the Federal Reserve do? It's already pulled out all these programs in an unprecedented fashion. And that is the liquidity has really supported the market, the stock market. But where do we go from here in terms of the artificial stimulants for monetary and fiscal policy? I think we're really kind of at a plateau here. And the bitter divisions in Congress, I think, are starting to come to the fore again.
So, yeah, I think it's so much uncertainty, and of course, like there's a lot of people suffering, people dying, and of course, in countries like Mexico, this is a big topic. You know, like people don't have even they'll be struggling to even to eat. I don't know. You know, it's and even worse in some other countries. So we're talking right now about stock market, but the pain in Main Street is it's real. You know, it's as Tom said. You know, and but anyway, I would like to take some of the questions.
There was a report out this morning of studies that are now showing a serious increase in mental illness, serious medical issues with people suffering from stress, anxiety, unable to see physicians, unable to get appropriate medication, increase in suicides, domestic violence at home, child abuse. There's so many side issues that are emanating from this crisis. It's really beyond belief in our lifetime. You know, 2009 were bad. It's pale in comparison to what we're looking at now.
Yeah, I totally agree. It's a tragedy all over. But well, I'll try to take some questions. Maybe probably this one for Jaime. What is the future of brokerage houses? With this pandemic, many were able to see the benefits generating to having workers do their work from home. Will this accelerate the introduction of AI in the market and be competitive? What can we expect from those of us who want to become advisors or are willing to you know, for the question is basically, what is there for asset managers and how this will change for people that want to become advisors? Is this going to be a lot more of AI and less, you know, human dependent?
Well, I think we all are trying to incorporate new models, quantitative tools into the investment process, and use all the technology and the computer power to simulate and to construct alternatives and to do stressed scenarios. So even though we try to program some tools that they can also learn by themselves. It's an approach of AI. I think we cannot stop technology into this business and into any other business. So regarding the brokerage house approach, well, for example, we don't have now the sales representatives or financial advisors into the brokerage house. And I think the businesses are separating each other consistently. because brokerage house, unless they try to be an asset manager, they will have all the process. But the model is moving more into transactional brokerage house for booking positions, but not without sales. There are still in Mexico many brokerage houses that have sales and try to do asset management. But I think that's not the trend on the industry. So that would be my approach to that question.
I think we saw what Morgan Stanley did with E-Trade, right?
Exactly.
So it's the other way around, like asset managers or wealth managers acquiring discount brokerage.
Yes, it depends if you are trying to sell execution or you are trying to sell financial advisement. So which kind of model you're trying to do, or maybe you are trying to be a boutique, or maybe you will try to cover all the asset classes. There are many different business models out there, but technology will impact all of them by sure.
Okay, we have another which you probably already answered. There's one that I would like to address to Igor, since the question was online with that. Where do you see? Do you have any thoughts about where you will see the Mexican Stock Exchange or like the IPC on 2021? Trying to unmute. Okay.
Well, that's
Podcast?
always the sort of question that is delivered to, let's say, stock analysts. And probably if I get enough tools as to assess that answer, I wouldn't be a professor at a university and would be probably just enjoying of my profits, you know. But well, I probably just make the remark on some of my previous comments that I foresee a higher level in the index. As I was mentioning, I think that we are facing a stage of slow recovery. And if we follow this concept of the leading phases of the stock cycle before the economic cycle, I think that in 6 months from now, we're gonna see the same shape of recovery as we might be seeing in the stock markets. Obviously, there is this concern that Alex pointed out, that it is still to know what kind of shape this recovery will have. Is it gonna be really a V? Is it gonna be a W? For instance, if you have a V shape and you have this side being so slow, I'm gonna draw it the other way. If it started coming too slow, this V is almost becoming an L, right? An L shape would mean really that there's no recovery and the economy keeps on the flat low side. So the signals that I'm reading now and that I shared with you is that I see this recovery, and thus I would be expecting higher levels, probably similar to those that we had at the beginning of 2019, probably.
Thanks. I would like to address the next one to Salvador from Juan Pablo Nieto. What's your opinion on the IMF and the World Bank behavior during this crisis? Are they acting like they're supposed to be?
Well, I believe there is always a room for question how global authorities, how global international institutions are behaving, because as it happened in a micro level, for example, within individuals, it also happened with institutions regarding information. I mean, there is no a total certainty about the information countries provide to international institutions. So while you can have some countries that are giving information that you consider to be trust, there are several other countries that are making up data or statistics. So when it comes to take a decision or to make a point, stand by an idea, there is always room for question that kind of behavior. It is all the same with information. I mean, if there is no way for you to verify the information of to trust the information, any decision you may take, it's like not reliable as it should be. So in specific with the EMF and the World Bank, I mean, there are just pointing out what global behavior should be with regarding, for instance, economic activities, or regarding perhaps the way that the health crisis is being addressed, or the way, for example, debt is going to be considered in the future years for governments as an instrument of economic policy. I think that nowadays globalization within this environment, it's not as good as it used to be. I think now each particular scenario needs to be considered for the main features of a particular economy. So you need to be aware what's the main characteristic for a particular economy to understand how it's going to be their behavior in the future. I believe that general solutions, and I believe that an optimal way to solve problems now, it's no longer as the way it used to be. We are facing now a structural change in economic terms, and it comes down to consider your own particularities to solve your own economic issues.
Yeah, I think like the IMF, they can help to provide liquidity, but they won't be solving the whole thing. Then want to see about regarding manufacturing.
I love that. That's a great question.
Yeah.
And I think, if I could just address that, I think increasingly companies are looking to hedge their bets. And so I do expect there'll be any number of products currently produced in China that will be diminished, and that business parked elsewhere. And I spent over 10 years in Vietnam, and that certainly is a good place to stop off at. Nike be a good example. While it has substantial operations in China, it has hedged its bets over a prolonged period of time, Vietnam being a big source of Nike production, and other countries as well. So I do think that companies will increasingly not want to have China, infuriated with them, but reduce some of the product. And by the way, there's more pressure in the States now, made in the USA, not made in China. We have, by the way, seen a retaliation, which I think is disgusting, of people refusing to visit Chinese restaurants in America. This backlash that unfortunately has been led at the top of our government leadership, which is very, very inappropriate. But I think hedging your bets, moving some business to Mexico, very, I think, appealing. By the way, what happened to the wall? We haven't heard any conversation on the wall now for 3 months. Has that construction come to a screeching halt? Do we now realize we need to be traveling back and forth to Mexico because of opportunities there? Can they help salvage our auto industry by moving manufacturing there? I think the answer is yes. So changing times calls for changing philosophies and policies. But I do think you will see other countries benefiting off of what's happened in China. That being said, I had a conference call yesterday with a student in Beijing, and he said, you know, Professor, we're a one-party country, you know that. But Professor, my country locked us up initially in our homes. We could go really nowhere. And he says, we think that was the solution to why in Beijing this morning, we're almost at full operation. So again, different countries taking a different approach. There is obviously some negativity in the air towards China and when it reported and how it reported. And I do think some companies will be looking for opportunities outside. Any of my colleagues want to share any thoughts on that important question, which is manufacturing and where it goes?
Well, I agree with you. Not only because of the political ideas that have been built around the idea of manufacturing, because especially in the case of Mexico, the production chain and the flow of products and goods through the border many times in order to create a final product for customers is a reality. So for example, now that the US is thinking on opening some industries, that puts pressure on us in order to also open, even though we are lagging in terms of how the pandemic is moving in Mexico, we'll have to open to the auto industry in order to fill up this production chain. So I agree, and we are gaining some competitive advantage in terms of manufacturing against China.
Totally agree. And we have a trade agreement, right?
Yes, a new one.
Yeah. Any closing? I would like to have like, you know,
Well, look at
closing.
that look at the last question that somebody posted.
Oh.
We're not increasing inequality, and boy, are we ever. I mean, it is just, it's so sad as to what we've become, the haves and the have-nots. Again, how many families are going to bed hungry every night? How many families are struggling to put any kind of food? Look at the lines. We see this every night, people lining up with food banks. And if ever there was a time for us to be in a giving spirit, this has got to be it. And I think for those of us that are employed and have benefits, we should be so appreciative of what we have and look at what others have not. That'd be my closing comments.
Yeah, I posted one of the initiatives, but any initiative, you know, I think it's good. The one I put it there, it's for Mexico, but there's a lot of different initiatives, and I think we need to be a little bit empathic right now. I agree with you. And I would like to ask anyone to have like, you know, like any closing remarks of each one of you before.
Yeah, I would just second what Thomas was saying. I think the big question is during the early part of the presidential campaign, we had people were talking about the Green New Deal, paying health care for everyone, and that sort of thing. But that wasn't talked about anymore. But my question is, I don't know the answer. With this crisis and the aftermath, are we going to have a repair of our healthcare system and the inequality that we see? It's increasing incredibly every day that we're just looking at this. You have, in Europe, you have the governments taking care of people's payroll. the healthcare system is not broken. So my question is, are we going to start changing the dynamics in the system here? All right, we'll have to drop off in 2 minutes for another call.
Yeah, thank you very much, Alex, for your closing.
Alec, you almost have to wonder, did Bernie Sanders drop out too early?
Right.
That was certainly his message. And if he were still a candidate today, that message would have a lot of strength.
Well, hopefully he was going to have an impact because
Yeah.
he has such a big constituency. So we'll see what happens.
Yeah, I agree.
Yeah. Igor, Jaime, Salvador, Gerardo, any closing remarks?
Yeah, I will say that from the economic perspective, there is always a calm after the storm, right? So I do believe markets around the world are going to rebound for this economic crisis. So we just need to look for that rebound in the near future, and then see what economy is going to be, what's the structure going to be for the new economic reality. I do believe that we are experiencing a structural change. So we are going to face that, but global markets are going to rebound, are going to be rebuilt, and we just need to look for that positive rebounds in the near future.
Thank you. Igor, Gerardo.
He has a mute, Juan. Igor is mute.
You have a broken connection.
Now,
Yeah, sorry.
No problem. A great learning today, and my idea is that we have a better capital market than the fixed income today, since of point of view of the profits. But you know that we are seeing things never seen before. But we must be confident that the time to the variables of the market will be better than now. Today, when I listen all the strategies that, for example, BBVA mentions, must give us the trust in the experts. I think it's very good to invest. And the final idea is the best proposed to invest is to start.
Thank you very much. And on that point, I would also like to restate our agreement with the Mexican Stock Exchange and providing this free educational program to pretty much everyone. And it's a very noble thing to do right now to provide education while people are in quarantine. I think it helps at least, on a mental health as well, to keep being active and learning something. I appreciate that.
precisely, Juanjo, as
Gerardo,
we're talking about investments, education, financial education, stock exchange education is a good investment these days now, that we have to look after different ways of getting our income, of getting to understand what is going on in the economy and our surroundings. I think that these opportunities are quite good for, let's say, people generally speaking. And if that's not enough, well, here we have great universities represented as in a person of Thomas, Salvador, Gerardo Aparicio, and myself. And we might be always offering a good opportunity to people that want to be more aware of these topics and even to make a profession out of this.
Yeah, we really appreciate your time because it's, you know, you live from this and giving this to people just for free. It's pretty, you know, it's kind of giving as well. Jaime, any final remarks?
Oh, well, I think my final remark is it's also time to be sensitive about many people that are facing adversity now. Try to help as much as we can. And especially in my business, try to stay close to clients and provide them with solutions that are understandable.
Right. I really appreciate all of you, your time. I'm taking a little bit, 3 minutes over, but I really want to thank you all. We had a lot of expertise and a lot of you know, knowledge, and I know your time is very valuable. So I hope the participants enjoy this, and I'll be sending this recording to all the universities, to the Mexican Stock Exchange, and it's very valuable to have you here. I really appreciate your time.
Thank you very much.
Mhm.
Thank you, Juanjo.
Thank you, everybody.
Thank you very much, and awesome to have you guys. It was great, you know. Yeah, I think it was. Thank you very much. Gonna stop the recording now.
Bye-bye.
All right, take care.
Thank
Take
you.
care.
Thank you very much.
Be safe.